Welcome back. My name's Chris Gosselin from Australian Fund Monitors. Today I'm talking to Richard Brennan from East Coast Capital Management. Richard is the Strategy Ambassador for East Coast Capital Management. And East Coast, as we've seen before, follow a trend-following strategy across a whole range of financial instruments. Richard, welcome.
Hello, Chris. How are you? Thanks for having me on.
My pleasure. Let's jump in. State of the trend in the first quarter. It was a pretty volatile sort of quarter. Trade tensions are escalating globally. What's happening in the state of trend?
Well, Chris, as your audience will be well aware, the turbulence of the first quarter led to what we call whipsawing markets. But this wasn't just in equities, but also in fixed income markets and currencies. So we viewed the last quarter as one of general uncertainty reflected by shifting international interests.
So given that environment, how did trend following perform generally in the first quarter?
Well, it was a mixed bag, Chris. So trend following systems like ours, which are rules-based and diversified across multiple asset classes, they did have challenges with those reversals, but we also saw strength in commodities like natural gas, coffee, and metals such as gold, silver, and copper. And this did help to buffer trend-following portfolios. So ultimately, whipsawing markets are challenging for our models, but in our view, they also create opportunities as new trends emerge.
Richard, you mentioned that things are particularly volatile or have been particularly volatile in the first quarter. How does the fund and the strategy handle that volatility? Is it a question of going to cash or switching out of non-performing positions? How do you protect the downside in that environment?
Well, in this volatile regime we've discussed, it's inevitable that it takes time for portfolios to adjust to new regimes, just like any other alternative investment strategy. But the models that we have do dynamically adjust to new regimes. So, for example, we found that in the first quarter, within these volatile environments, particularly in equities and bonds, that are embedded risk management systems within our portfolios, they de-risk the portfolios and they close out those markets that are not trending and they turn them into cash. This therefore means that we then build up a cash buffer so that when new trends emerge, new signals emerge, we're ready to sort of capitalize on that. So that's the way our models adjust to a new regime. But we see diversification as one of the central key strengths of our program. So having a broad investable universe gives us maximum opportunity to be well positioned for whatever new trend may emerge in a new regime as markets go to this new normal. What is the new normal? What are the particular assets that are going to be trending in that? Of course, we can't see that and at the moment, but our portfolios actually dynamically adjust to those opportunities. So it might be, for instance, commodities or specific geographies such as Europe or US, and we find that the signals then arise in those areas, and with a diversified portfolio, we can then jump into those opportunities. So we have seen over many decades of historical data and academic research, Chris, that this style of investing will pivot over time to a new regime and the new opportunities that such a new regime offers.
One of the things that really has been trending is gold. Tell me about the trend in gold.
Yes, well, that's been a magnificent trend, Chris. So in quarter one, we had gold rise about 17%. And we attribute the main drivers of this strong trend in gold to things such as central bank buying, inflation hedging, and the general sort of global investment response to increasing geopolitical risk. So gold's been this classic example of a great trending market over the past year or more. But it's also interesting to note that the uptrend in gold emerged well before the US federal election. And we do often find this, that the drivers of trends don't fully sort of emerge until after the trend is in play. But you're right, Chris, with these diversified portfolios, there's always a trend somewhere, and if we can dynamically allocate into those, we find that we can definitely find buffers against these sort of adverse whipsawing regimes.
Richard, you mentioned diversification, and that's one of the great benefits. And generally, people think of diversification as, let's look at private equity, let's look at maybe even crypto and currencies and uncorrelated assets. But there's a lot of diversification possibilities in trend following futures, is there not?
Definitely is, Chris. So it's not just across the markets themselves. So we have very diversified portfolios across all of the asset classes and across markets, but also geographies. And with our models, we do get a degree of diversification in our models as well. So there's all of these different angles within diversification that ultimately assist us in producing very strong risk-adjusted returns.
Richard, academic studies are one thing, but your fund, which has now got 5 years track record, maybe a little over 5 years track record, it's performed well. It's produced 15% per annum over that time after fees, which is pretty impressive, with a maximum drawdown, I think, of 5 or 6%. So it's historically, it hasn't been overly volatile, and it has provided that pretty consistent return in sort of mid-double digits.
That's what we find, Chris. So we've been fortunate, of course, since inception. We have produced a very good result. We're very happy with it. It's about 105% cumulative return since inception, leading to about a 15% annual return. We're very happy with it, and the strengths of it is particularly our diversification and our commodity focus. So unlike, for instance, other trend followers, we tend to have an increased allocation towards commodities as opposed to the traditional investments such as equities and bonds. We've got a bit more exposure in commodities. Those commodities that we're invested in are typically things that the general investor might not have access to, but within our diversified portfolio, that gives us a lot of opportunity, tends to give us a very solid risk-adjusted return due to the low correlated properties that exist between the commodities we invest in and the balance of our portfolio, which will be in these other asset classes.
Richard, just switching for a moment to operational issues. I understand you've got a new member of the team at East Coast.
We certainly do, Chris, and we're delighted to expand our leadership team to include Mary Zhu, who's our new Chief Operating Officer. So Mary brings 20 years of investment banking experience at Bank of America, HSBC and Deutsche Bank, and in recent years she was Managing Director at Bank of America in Global Business Management and Chief Operating Officer roles in both Sydney and Hong Kong. So Mary Zhu is another fantastic addition to the team as we continue to grow and expand.
That's a pretty impressive CV. Richard, it's always good to speak to you. You produce this state of the trend report on a quarterly basis. We'll look forward to speaking to you again, if not before, in 3 months' time.
Many thanks, Chris. It's always a pleasure.
Nice to see you, Richard. Thank you and goodbye.